Most people misunderstand risk in business. They assume entrepreneurs are simply people who take big risks, people who jump into uncertainty and hope things work out. But the truth is almost the opposite. Smart entrepreneurs are not reckless risk takers. They are risk managers. They don't eliminate risk completely. That would make business impossible. Instead, they structure their decisions so that the potential reward outweighs the downside. Every meaningful business decision carries uncertainty. Launching a product, hiring employees, expanding into a new market, investing capital. These decisions involve variables you cannot fully control. The difference between struggling entrepreneurs and strategic ones is not courage. It's how they think about uncertainty before acting. Successful founders don't ask, "Is this risky?" They ask, "What is the downside if this fails? How much can I afford to lose? Is the upside worth the risk?" Companies like Amazon grew through bold decisions, but those decisions were rarely blind gambles. They were calculated moves where the long-term upside justified the uncertainty. Risk in business is not about avoiding mistakes. It is about designing decisions where mistakes are survivable. Understanding this mindset changes how entrepreneurs build companies, allocate resources, and pursue growth. Let's break down how smart entrepreneurs actually think about risk. 1. Calculated risk. Decisions with asymmetric upside. One of the biggest myths about entrepreneurship is that success comes from taking huge leaps of faith. In reality, successful founders focus on calculated risk, situations where the potential reward is significantly larger than the possible loss. This idea is called asymmetric risk. Imagine spending $10,000 testing a new product idea. If it fails, the loss is limited. But if it succeeds, it could generate hundreds of thousands in revenue. That is a rational risk. Smart entrepreneurs look for opportunities where the downside is manageable, but the upside is large. In the United States, companies like Airbnb started with simple experiments. The founders didn't immediately build a global company. They tested a concept, renting air mattresses to conference visitors, and validated demand before scaling. Opinion. Many entrepreneurs fail not because they take risks, but because they take unstructured risks. They launch products without testing markets. They invest heavily before validating demand. They expand operations without understanding unit economics. Calculated risk means experimenting with small, reversible decisions before committing to large ones. Smart founders treat risk like a series of tests, not a single gamble. 2. Portfolio thinking. Multiple bets, not one. Another major difference between inexperienced entrepreneurs and experienced ones is how they distribute risk. Beginners often place everything on a single idea, product, or strategy. If that one bet fails, the entire business suffers. Strategic founders think more like investors. They adopt portfolio thinking. A portfolio approach means running multiple experiments or opportunities simultaneously, rather than relying on one outcome. Technology companies do this constantly. For example, Google launches many products and experiments each year. Some fail quietly. Others evolve into major platforms. The logic is simple. When you run multiple experiments, the probability that one will succeed increases. Portfolio thinking also applies to revenue streams. An entrepreneur might build a core product, a subscription service, digital products partnerships. If one stream slows down, the business still survives. Opinion. Entrepreneurs who rely on a single strategy create unnecessary vulnerability. Diversification is not only for investors, it is a survival strategy for businesses. Smart founders spread risk across multiple opportunities instead of betting everything on one outcome. 3. Downside protection. Survive. First, win later. One of the most important principles in entrepreneurship is simple but often ignored. If you cannot survive failure, you cannot take risks. This is why smart entrepreneurs always think about downside protection. Downside protection means structuring decisions so that even if things go wrong, the business remains stable. This can include maintaining cash reserves, controlling operational costs, avoiding excessive debt, testing ideas before scaling. In Nigeria's fintech ecosystem, companies like Flutterwave expanded rapidly but still maintain strong financial discipline to manage operational risk in a complex market. Businesses operate in uncertain environments. Markets change, regulations shift, competitors emerge. Downside protection ensures the company remains resilient during turbulence. Opinion. The goal of early entrepreneurship is not maximizing profit immediately. The goal is staying alive long enough to find product-market fit. Businesses that survive uncertainty eventually gain experience, customer insight, and market position. Businesses that collapse early never get the chance. Smart founders prioritize durability over short-term gains. 4. Opportunity cost. The risk of choosing the wrong path. Risk is not only about what you might lose, it is also about what you might miss. Every business decision involves opportunity cost, the value of the alternative you did not choose. If a founder spends 2 years building a product nobody wants, the cost is not only the money invested, it is also the lost time that could have been spent building something more valuable. In the UK startup ecosystem, companies like Revolut moved aggressively into global markets because waiting too long would have allowed competitors to dominate the opportunity. Opportunity cost forces entrepreneurs to evaluate how they allocate their time, capital, and attention. For example, should a founder spend months perfecting a product feature, or launch quickly and learn from real users? Should a business expand into a new market now, or wait until competitors capture the opportunity? Opinion. One of the most dangerous risks in entrepreneurship is playing too safe. Waiting for perfect certainty often leads to missed opportunities. Smart entrepreneurs balance caution with decisive action. They understand that the biggest risk is sometimes not acting at all. 5. Practical risk strategy. How smart entrepreneurs make decisions. Risk thinking becomes powerful only when it translates into practical decision-making. Here are 5 strategies experienced founders often apply. First, they test ideas before committing major resources. A small prototype or pilot launch reveals far more information than theoretical planning. Second, they keep fixed costs manageable. Businesses with flexible cost structures can adapt quickly when markets change. Third, they collect real data before scaling. Many successful products evolve through feedback rather than initial perfection. Fourth, they maintain financial buffers. Cash reserves allow entrepreneurs to survive unexpected setbacks without panic decisions. Finally, they review outcomes regularly. Smart founders analyze both successes and failures to refine future decisions. In Silicon Valley, startup culture revolves around this idea of iterative experimentation, testing, learning, and adjusting rapidly. Opinion. Entrepreneurship is not about avoiding mistakes. It is about making mistakes that are small enough to learn from and recover quickly. The goal is not perfect foresight. It is continuous adaptation. In conclusion, risk will always be part of entrepreneurship, but successful founders do not treat risk as a blind leap. They treat it as a structured decision. They pursue opportunities where the upside is large and the downside is manageable. They diversify their bets instead of relying on a single outcome. They protect the business from catastrophic failure. They evaluate opportunity costs carefully. And most importantly, they learn from every experiment. Smart entrepreneurs do not eliminate uncertainty. They build systems that allow them to navigate uncertainty intelligently. Because in business, the goal is not avoiding risk. The goal is taking the right risk at the right time. This is Business Decoded, where we explain how money and businesses really work